So this isn't typically a great sign when you see this correlation of between housing and the S&P 500 start to break down. So I'm going to walk through those charts, give an overview of today's market. We have a lot of, news headlines going on, including one that's not even mentioned that I just clicked through, the government shutdown. We're going to kind of look at the structure of the S&P 500, where things are within expected moves and market conditions. We're going to look quickly at some of the intermarket stuff on today's Stock Market Brief show. If you're new here, well, welcome to the show. Subscribe to the channel if you like this type of content. This is where we navigate the financial markets through the lens of technical and intermarket analysis. Let's go ahead and get into today's episode. All right, people, welcome back to the show. A lot of strange things going on in these markets, I'd say, right? We're like all-time highs, and we're getting, tweets left and right, and we're getting these volatile markets, at these all-time highs. And there's a lot of stuff going on via news, right? News catalysts and so forth. So, a couple of those things that came up, we talked about on a prior episode, and we talked about them being a potential catalyst for higher oil prices. Higher oil prices are typically bad for bonds, right? And yields typically follow oil. Well, one of the aspects of the news today that really shook markets up was around the China and U.S. tariff, but then also Wall Street Journal published an article today saying that the U.S. lifted key restrictions on Ukraine's use of Western long-range missiles. And this was something that we talked about 2 episodes ago, that if this were to happen, there could be a possibility for oil prices to start to rise. And we saw that today. But, it's hard to get a grasp of what's right and what's wrong here, because shortly thereafter, I think Trump tweeted, but there's also Reuters, or whatever you pronounce it, Reuters, whatever. Trump has said he did not approve this, the Ukraine's use for the long-range missiles. So a little bit of back and forth there. We also have potential sanctions going on Russia too. Besant says that the U.S. plans substantial U.S. sanctions on Russia. So what did the markets do today, right? Because we can talk about narratives all day. What did the markets do? Energy was up. Healthcare was up. Consumer staples and real estate. So these were 2 sectors that we kind of honed in on a prior video. We talked about how healthcare looks like it can potentially move from here, and how real estate. So we saw some nice little pops these last couple of days through there. Remember, you got to manage risk and continue to manage risk. Things can change on a dime in these markets. Then energy led the way. I want to hop right into this specific chart, and this is a weekly chart of the S&P 500. That's what you're seeing here. This little droopy line down here is the rolling 10-week correlation that the housing index is to the S&P 500. Now, as you can tell, so if you're look at this what? Basically, when you look up here, it's above this zero line the majority of the time, and you get a couple spikes down below. The reason for that is it's just telling us that the housing market on a 10-week weekly correlation to the S&P 500, it's typically positive, right? It's typically positive, meaning that they move hand in hand for the most part. And we've seen that countless times on this specific chart, right? Where you have housing index up here, you have the S&P 500 down here. And we talk about sometimes if you get these divergences where housing market, right, it doesn't keep going higher like the S&P 500 did, and it led to a sell side, all right? The housing market put in a nice higher low over here, but the S&P 500 kept on going down. That was a bullish divergence, and it led to a nice rally. And then more recently, over here, leading into the tariff tantrum over here, right, or the trade war, whatever you want to call it here, we had that divergence there. And then we have a bigger divergence that's still forming in the housing market relative to the S&P 500. And the reason why I'm bringing up this 10-week correlation, now the week's not over, right? It's Wednesday, so we still have couple more trading days left here. But you can see that we're getting these violent breaks in the correlation. And I've highlighted the other times that this has happened. It doesn't happen frequently when you get this bigger negative correlated break, but what you can see here is when I'm starting to highlight is it's actually in periods of actual market turbulence, or shortly thereafter market turbulence like this, right? So if I go over here, you can see I'm just highlighting the times that this has occurred. And what do you notice in the markets? You see that it leads to some sort of a, potential break of some sort. In fact, actually right here, right, if you go up, the market went higher, right? But then it still led to a bigger sell-off in the markets. And if you go over here, the market went through some turbulence. It went higher, right? It was totally fine, but then it broke lower. So are we going to see this potentially resolve itself before the week ends, or is this giving us some insight saying that we still have potential turbulence in this market in the very near future, as this has given us some good insight prior. I don't have those answers, but what we can do is look from a more tactical basis and how to approach the market. When I see something like this, when I see it, it's more of a warning sign, right? It's not a signal to go, hey, I'm going to go short everything, to infinity and beyond, right? To the depths of whatever. But what it does mean to me is my foot typically comes off the gas. I'm a little bit more cautious and I just manage my risk more effectively. It tells me that, hey, if a trade's not working, you get out of it and you respect that, because the market can be, it could be walking into some bigger problems. If we take a look at the S&P 500, how it looks on the daily time frame, we've recovered since this original Trump tweet, and you can see that we're kind of grinding itself higher right into that 6,700, right? Underneath the 6,700, we were talking about it'd be a little bit more bearish. Above it, it's going to hold to be a little bit more bullish. We'll see what the structure of gamma looks like now. But really, it's been kind of just drawing itself higher, maybe potentially flagging and kind of bumping right into its prior highs here. If we continue on and look at the expected move for the week, it was about a $13 expected move, and we're still up on the week. Last week, we were up on the week. This week, we're up right now. It barely so. So we're getting, a volatile move today where we got, down on the week, but ever so slightly, and we found ourselves a little bit of a bounce from that point. And you could see just how profound this day was. And from that, we've never retested those lows. We kind of just been choppy with some really big intraday volatility. Today's intraday volatility did drive us outside of the daily expected move. And then where did we close? Right back inside the daily implied move, right near that 5-day moving average. I will note that this is a pretty aggressive bounce back, okay? And we're below a declining week-to-date volume-weighted average price. So if price were to come up further, be aware of the week-to-date VWAP, because it's held as support before, right? This was, we talked about, I don't remember where I talked about this. Maybe it was a live stream. Watch for the first test of the week to date, because when it happens, you typically get your bigger reaction from it. Okay, that was the big reaction. We tested it again, came up, we going for it again, and then it broke, right? So now if we back test it, if it held as support prior, perhaps it can also hold as resistance. Okay, so just be aware of that. Now, going into tomorrow's trading session, our expected move can bring us up to around 672 and down here at 663. These are still some pretty big expected moves, and that is just what the market is pricing in as far as risk. And if you think of this in terms of a distribution curve, right, 68% of the time, it ends up tagging one of these and or closing within those expected moves. The weekly implied move, right, we still haven't tagged either, so the market is still saying, hey, there's a lot of risk here. Now, I will note that the S&P 500, the SPY did hit last week's implied move, but if you actually look at the SPX, it was a little bit bigger of an expected move, and we actually didn't tag it there. So if we don't tag the weekly expected move this week with the SPX, that'd be 2 weeks in a row without tagging it, and that's also fairly rare to occur. If we look across the board, SPY, Qs, IWM, semiconductors, biotech, and DIA, you're seeing some red and green dots. This is just telling us the shorter term trend. Is it bullish? Is it cautionary? Or is it declining, right? It just tells us, is price below it? A declining 5-day moving average is, if it's declining and price is below it, it's it's red. If price is above it, right, and it's inclining, it's green. If price is below it, it's inclining, diverging, it's yellow, it's giving cautionary. That's what that's reading right there. And one of the bigger ones to just call out is that semiconductors is red. So if it comes up, is this telling us that, hey, we might be in for some more sell side in semiconductors? And if so, that pulls a big weight on things like SPY, right? Look at NVIDIA, or the Qs more specifically, and you can see Qs is actually below it right now, but the 5-day moving average is still inclining. If you look at small caps or IWM, this one's also below its declining 5-day, and then you have DIA that's still holding trend right now. If we take a look at the gamma structure, traders are still reaching out to that 7,000 level, and there's not much going on really in this range. So this is slightly below 6,700. So I'm going to take a look at what this might look like earlier in the trading session tomorrow. Our put wall is down here more towards 6,500. So if the market wants to come off harder, that'd be 200 points beneath us. And then you can see 6,800 is still a pretty large level to watch for if we can get above and hold that 6,700. If you take a look at market conditions, you can look at that gamma flip line. We're slightly there above it. So I would call this more gamma neutral. So just be aware, if you start cracking below these levels, volatility can pick up quite dramatically as dealers sell into the selling, buy into the buying. If we can remain above it and start breaking above, that is where it will drive volatility down, and you'll have dealers start to buy the dip, sell the rip, and move this market up higher. So we're really just on a fine line right here. So it's a time to be much more cautious, because this is where conditions of market, and I've shown this countless times of what it looks like when this market gets into negative gamma, and just how much different the market looks like in terms of intraday price action when that happens, and even longer term price action the longer we stay down here. It's just much more volatile. You get larger expected moves, more risk is being priced in, and so forth. So we're right there at that neutral zone. Time to be significantly more cautious. If we take a look at some intermarket stuff, the dollar has been on a little bit of a bid here. The 10-year yield has been falling, and this has been causing the market to really go nowhere. It's been just going sideways. And you can see when they both are falling, right, the dollar and the 10-year yield, it's been quite beneficial for the markets. You can see over here, nice and beneficial. But when they also go, up together, right, it's been pretty bad for the S&P 500. And right now, you're kind of getting this break in these correlations, and you're just getting some sloppy movement. Now, what can potentially drive the 10-year yield higher? I think that could be some of that geopolitical risk that we had mentioned, but also just keep an eye on oil. And the reason for it is because oil was up pretty significantly today, and I think it's trading a little bit higher here since the futures market opened up. And the 10-year yield was down on the trading session. And typically, you have these move hand in hand. So this black line, that's oil. The candlesticks is 10-year yield, and you can see they move hand in hand, and many times you'll see actually oil make the move before the 10-year yield actually does, giving us some insight of what could potentially happen next. And if that is going to be the case this time around, right, oil making its move higher today while the 10-year yield is, lower, that could indicate that the 10-year yield might head higher, which can drive the cost of these bonds potentially lower, or a period to consolidate in the near term, maybe making a good short opportunity or a profit taking opportunity, right? If you were looking at this flag pattern over here when we were talking about it and you traded, maybe it's a good time to lock in some profits and wait for consolidations. And when you get consolidations, maybe try to play some more forward breakouts. But that would be kind of the risk that I see here in the near term is oil catching a bid, 10-year yield goes up. 10-year yield goes up if the dollar remains kind of where it's at, or bid. Maybe that puts a little bit more pressure on the market. So there are some catalysts that can drive that. We do have CPI this week. We just had Tesla earnings, not looking all that great as far as the market's reaction. I didn't look into the numbers, but that's all I got for you on today's episode, everybody. Just be aware of some of these dynamics, some of these market conditions. Things are changing. We're kind of in that precarious place, right in that gamma neutral zone. But yeah, that's all I got. See you later.